that fear of losing your job. So is that what like led you on the path to wanting to achieve financial freedom?
Yeah, you would think so, wouldn't you? But something must have happened. And I was just really annoyed with myself. And I sat down and I said, listen, your role is to preserve and build wealth for wealthy individuals. Make sure they don't lose money. And on an annual basis, you're meant to grow that. And I said, your bank account does not reflect that relationship. What on earth is going on here? I just never wanted to feel like if I lost my job tomorrow, I had nothing to fall back on.
You said it wasn't a plan to retire.
But it got to a point where I wanted to take a mental and physical break from work. Just, 6 months, 3 to 6 months. 6 months became a year, 2 years, 3 years, etc. So the years just rolled by. It wasn't a plan. I was really aggressive with my money. So I'd say in a good month, 70 to 80% of my pay went into my investments. It's about either compounding and growing your wealth for your future self or consuming all of that now and having nothing. Your income or your salary is, for most people, that will be the seed capital that funds your investments. So please be nice to your employers and be polite.
Beyond AI, are there any other global trend sectors or themes that you think are being ignored but could quietly create the next wave of millionaires over the next decade? Welcome back to another episode of the podcast. I'm your host, Atto. We have a special guest in the building. We have Jumoke, who's an investor, wealth educator, and former investment banker at a top-tier global bank. After nearly 2 decades working with high net worth clients, she's built her own path to financial freedom in her 30s and now helps others rethink how they build wealth, manage risk, and buy back their time. Jumoke, how are you doing today?
I'm very well, Atto. Really nice to see you and be here. So thank you so much for having me.
Welcome. You know what's crazy, right? So I've told you this already, but I saw your video. I think I might have seen it about a few months ago pop off. I was like, oh, wow, like this is really interesting. Yeah. And I thought it would be great to have a bit of a conversation because especially in the UK, we as you know, we don't talk too much about money. We don't talk too much about financial freedom, and we don't know that many people that have achieved it. So, the fact that you've done that, I think is really inspiring. And the fact that you're now sharing, the information with others is even better, as well. So yeah, no, it's great to have you on the podcast.
Thank you so much.
So for anyone discovering you for the first time, how would you describe who Jumoke is and what you do?
Okay, so hi everyone. I am an investment banker at heart and of course by training. I'm also an economist. Throughout my career, I have looked after high net worth and ultra high net worth individuals, families and institutions in the EMEA region, which is Europe, Middle East and Africa. And essentially I was an investor on behalf of these individuals and families. So I went through the whole journey of being an analyst to an associate, and my last role was deputizing as a chief investment officer for an international bank here in London. Lots of travel. I traveled once or twice a month for 7 years, so it was very interesting times. But right now I am a lady of leisure, if I can call it that. I just spend my time at the moment traveling, spending a lot of time with family, which I wasn't able to do as much as I wanted to in the past. And also I am still an investor, of course, but I also produce content, or I put out information online, YouTube, for individuals who are looking to navigate this crazy but interesting world of personal finance. So these videos are meant to be sort of hand-holding videos for individuals like that. So
Amazing.
That's me in a nutshell.
Amazing. And you do a lot of work. You know what? I want to say thank you for sharing this back, because a lot of people do work in the industry and they don't share the information back, and it's such valuable information. A lot of them will achieve what you've achieved and then they go about their day and they're not like trying to really give back.
Yeah.
And the fact that you're doing that, I think is
I try.
It's admirable. No, you're giving great information. That's why your channel's grown, to the level it has. And I think that's very, very important. When you look back over your journey from building a career in finance to achieving financial freedom, what experience do you think shaped the person you've become today?
I think there is a panoply of things and experiences over the years, but I'd say first and foremost was my mother. She herself was a banker, And growing up, she was quite senior actually in that time. And it was very rare for a woman to have achieved that level of seniority in investment banking. So she instilled in her children, the art of respecting money and making it work for you. So from a very tiny age, she taught us about saving. She was an investor herself. So she bought us landed property, back in my home country, but she bought us property. She bought us shares. She encouraged us to save. So just watching her growing up, I already had that in my brain that, well, even though I didn't exercise it immediately, when I started working, I always had it at the back of my brain that there is a certain relationship you have to have with money. And it's important that you define that before it starts to accumulate. So that, as well as just meeting some incredible, clients and talent as well that I worked with. So incredible colleagues who were mentors, really, just watching them, and how they allocated funds and their approach to money. Clients as well, you learn so much from the psychology of the rich, from just being around them and listening to them and understanding how they, navigate risks and things like that. Yeah. And also just, generally life, understanding the fleeting nature of money. It's here today, it's gone tomorrow, unless you're very intentional about how you allocate it. So I think those are some of the things that have shaped where I am today. Yeah.
I wanted to know about the client side, because I think that's always quite important. What would you say some of those principles that you feel like you learn from, your clients?
Yeah. So I think the interesting thing is, I think that the psychology of wealthy individuals isn't far off from the average person. I think the difference is how they go about implementing. So they take actions when they've, thought about things, and it's not just, they don't just say it. There's a lot of action behind that. They have calculated risk decisions, so just looking at some of them over, when we had market crashes as well, how they dealt with their portfolios. I had one group of clients who I love very much, of course, but were very sort of risk averse. And then another group who doubled down to increase their wealth over that period. So you just learn so much by being around these individuals. Yeah. I once sat with an extremely wealthy individual, one of the wealthiest men in Africa. And I remember we're talking about a specific company, and I just asked a few questions around it. And he said to me that if I was to lose 1 million, he says, I know where each million of my money goes. This is a billionaire. So in my mind, I was thinking, oh, that's very interesting. I smiled politely, but I thought, you're a billionaire. Like, why do you care about a million? But he said he wouldn't be able to sleep well at night. So it just shows you, and I also realized why God hasn't made me a billionaire just yet. But it helps you realize that for them, it's not just about money. This is a lifestyle, and they respect money a lot. So you learn a lot from just, listening to them and helping them grow their wealth as well.
Yeah. It's interesting because, when you get more money, some people do think it's going to solve all their problems, but at the same time, it does bring that, air of, that fear of wanting to lose it, right? Because if you work so hard to become a millionaire, you really don't want to then get there and lose it, So that psychology is quite important. I don't know if enough people think about that when they get there. They're always thinking, okay, the lifestyle, but when you get there, you're going to really, truly live that lifestyle, and you have to maintain it as well.
Of course. And as you said, I think accumulated wealth through working 9 to 5, whatever, building a business is quite different from inherited wealth. Yeah. Where you've maybe been accustomed to a certain lifestyle and, money isn't such an object to you as such. But if you've worked very hard for every single penny, it hits differently when you lose it, I think. I'm not saying, of course, those who have inherited wealth are not careful or don't feel the impact, but it's a different feeling when you've strived extremely hard for every single penny and you're not used to, being around wealth, maybe.
Yeah. So my follow-on question for you was, after nearly 2 decades in investment banking, working with high net worth individuals, what moments from that world left the deepest impression to you? So obviously you mentioned the very, wealthy person, but were there any other moments?
Oh dear, so many of them. I think, like I said before, I think working with some of the most extremely intelligent individuals. Some of my colleagues were just, so when I started working, I worked in one of the hardest investment banks to get into in the world. It was really sort of a rigorous process of getting in. So I interned first, and then I was offered a position after university. And, working with some of these individuals who were just brilliant minds, you learn a lot. And so it was a very steep learning curve for me in the beginning. It was hard, my goodness. You spend hours and hours at work. You don't sleep. Your sleep sort of suffers for the first maybe 5 years of your career, but you learn so much. And that was really a rewarding period for me. But also I remember during the Great Recession of 2007 to 2009, and it really felt like the world was coming to an end at all. It was, on one side, you had the markets doing things that no one had ever seen before. It was just, really high volatility. The VIX was, at sky high levels. But you also had the fear from your colleagues just watching the entire, because people were getting laid off at that point.
Yeah.
So I remember, I was on the floor at that point, and you would get a call. So if you got a call, it most likely was HR asking you to come in for a little conversation.
Wow.
So people weren't answering their phones. And we had clients calling in, trying to, place trades and stuff like that.
Oh my God.
It was really interesting, the fear. And I remember feeling or saying to myself, I never want to feel like this again, where if you lost your job, that's it. There's nothing else. So that was a very tumultuous time for the markets and those of us in banking. But yeah, it was quite interesting as well. So lots of things. There's one particular strategy I remember I worked on with that bank, and it was one of the biggest. I think it was the first one that ever been done. And it was a program which is now sort of open to, 20 years after, it's open to, 18, 20 years after, it's now open to retail investors. When I see it, I think, I remember 20 years ago when I worked on that, and it was a money-making machine for a particular European client at that time. So that always stuck with me. And again, it comes from the brilliance of those I worked with to be able to conjure up the strategy, put it to market without moving the markets too much.
Yeah.
But yeah, just lots of memories with different clients, really.
Are you able to share that strategy?
I'd rather not.
Okay.
I don't know if I'm still under an NDA from 20 years ago, but
is that what they do?
Yeah.
Oh my
yes.
God.
But no, it's interesting.
God. Okay. That's okay. It's like, it's going to be interesting to hear like your experiences, especially because people are now saying, is the market overvalued, so it'll be interesting to hear, like, obviously comparing to, those times back then. We'll talk a bit more about that later. But you did say something very important, actually, in terms of that fear of losing your job. So is that what, like, led you on the path to, this path to wanting to achieve financial freedom?
Yeah, you would think so, wouldn't you? But I think after the storm had calmed in that period, and I realized, my job is safe. It still took me a while to get to the point where I was really considered about money and my relationship with money. So it took me a few years from then to, really get my act together. But I think a lot of things happened, and one day I just sat and I thought, so I was always in overdraft, get thousands in, thousands out. I was not saving. I was being very reckless with money. But one day I said to myself, I think something must have happened. And I was just really annoyed with myself. And I sat down and I said, listen, your role is to preserve and build wealth for wealthy individuals. Make sure they don't lose money. And on an annual basis, you're meant to grow that. And I said, your bank account does not reflect that relationship. What on earth is going on here, And so I said to myself, how long do you want to do this for, where you're getting money, nothing to show for it, and also at that point, I think I decided that I wanted to retire by the age of 50. So I had some runway to work towards that. But I think that was the point at which I started being very strategic as to how I managed my money, because I had all this knowledge. I was applying it to make my clients wealthier and to preserve their wealth, but that wasn't really reflecting in my own life. So I didn't want to be too much of a hypocrite. So I had to think about my future self. So that's sort of what instigated right, let's get serious about, things. Yeah.
Okay, so that's what made you go onto the path of, I want to build something out, financial independence outside of work.
Absolutely.
Wow.
I just never wanted to feel like if I lost my job tomorrow, I had nothing to fall back on. So, yeah.
Yeah. So obviously, when we spoke, you said it wasn't a plan to retire.
Yeah.
That you wasn't planning to retire at all, although obviously you've done a video on this that you didn't plan to. So then what happened around that? What happened if you didn't plan to retire? What gave you the conviction to be like, okay, it's time to take a step?
That's a great question. So as I mentioned, my last role was I loved it. I absolutely loved what I did. I loved my clients. I miss them so much, but I do speak to a few of them every now and then. But my last role really saw a lot of travel. And I think at some point it sort of took a physical toll on myself, years ago, but it still I still continued in the role maybe 3-4 years after. But it got to a point where I wanted to take a mental and physical break from work, just, 6 months, 3 to 6 months, just to unwind, figure out the next step, just relax. So that was the initial plan. Even though at that point I still aimed for 50, initially, it was just to take some time out, and 6 months became a year, 2 years, 3 years, etc. So it's just that the years just rolled by. It wasn't a plan. But the thing is, I also mentioned this to you, that when I retired, or I sort of became work optional, if I can call it that, before that, I was really aggressive with my money. So I'd say in a good month, 70 to 80% of my pay went into my investments. On a bad month, 40 to 50%. And I've been doing this for an extended period of time.
Yeah.
So I got to the point where my auxiliary income, if you will, or income from investments was more than enough to cover my expenses. So even before I retired, I saved up 24 months worth of expenses just to, have a nice. Yeah, I'm very risk seeking when it comes to investments. When it comes to life, I'm very risk averse. So I saved up 24 months worth of expenses, even though I planned for 6 months. And so, the time just rolled on. I thought, I'm really enjoying being able to travel, having autonomy. Yeah. And so it just became a point where I said, well, I don't see myself going back into a 9-to-5 for now. I never say never, of course.
Yeah.
But, it has to be an offer I can't refuse. Godfather reference. So, that's what happened.
Okay,
really.
That's what happened. And, that, because you had done all that work, it enabled you to be like, actually, the 6 months can extend to a year. I want to ask you, so you said your savings rate, what was it? And the highest was what?
Was around between 70 to 80%.
How did you achieve a savings rate of that
I
high?
was very frugal with money. So I came from a lifestyle of spending every penny and then some of what I earned to a point where, because I was seeing the returns I was making, and some of my investments had doubled, quadrupled in size, I think it gave me a little bit of an addiction to investing. I don't say this in public, but I was a little bit addicted to investing because I could see the difference it was making. Yeah. And it built a cushion for me to think, well, if I lost my job today, God forbid, I will be okay. So it really helped me stop the frivolous spending. And every year when we got bonuses, as bankers do, 100% of that went into investing.
Wow,
I didn't spend any of it. No.
Wow.
So I kept my costs really low. And I even talked about on one of my videos how much I pay for my mortgage right now, which people don't believe. And I understand why, but it's really low, really, really low for a 3-bedroom, 2-bathroom house in London. But again, that's because I watch economic cycles. And I remember my broker at that time saying to me, let's lock it in for 2 years and then you can do 5 years or 7 years. I go, no, let's go for the extended period. And luckily I still have a few years of runway on this very low interest rate. Okay. So things like that, Okay. But that's sort of how I navigate.
Okay. So what would you say is the most frugal kind of thing you do? Because I'm trying to get people to think about how can they be a bit more frugal for themselves. Yeah.
There are lots of things that you can do. Obviously, in London, living is it's so expensive. No thanks to Rachel from accounting as well. But there are several things you can do. So if you are perhaps renting, or if you own a house, for example, one of the things I did think about doing, but I didn't end up doing, is, maybe renting out a room in your home to bring in some income to help with your mortgage, or if you're able to sublet, for example, you can bring in income that way. Being intentional as well about your spending. So having a budget really helped me when I started. I didn't believe in it initially. I just thought it's for elderly people and my parents, but, having a budget really helped me see where everything was going. So you need, if you're serious about this, there's no other way. If you don't know what's coming in and what's going out, how do you know what you have left over to give to your future self with? Yeah. So a budget is really important. You sit down. It doesn't have to be anything complicated. There are many sort of templates out there you can leverage. It doesn't have to be anything sort of expert. So just having an incoming, outgoing, knowing what your income is, your expenses, your savings, your investments, things like that. So a budget is really important. Planning your meals if you're that kind of individual, knowing how much you spend every month on your meals. If you drive, maybe the cost of driving is a little bit too much. Maybe sometimes you can take, the buses or the trains. So there are many things you can do. It just really depends on your lifestyle. One of my vices was shopping. I love coats. I have a weakness for coats. And I spent a lot of money on my coats over the years. So I had to sort of say, okay, now you have 30 something coats. Maybe it's enough that should be enough to see you through the rest of your life. So stop with the coats. So, I had to cut back on spending on clothes as well. And it's one of my biggest regrets, because I spent so much money on things I didn't need over the years. And you learn as you go ahead. So, That's what I was saying.
You know what you said? You said something earlier which was interesting, which was as you saw your investments rising, it kind of got you to be even more frugal, which is interesting because I feel like I've had a similar effect, because you're always probably like calculating, but I could just invest this and make more money. Yeah. But I've spent it. And I think if people were to engage with investing more like that and they could see the growth, I think more people would be more control of their money and see what they're losing out on.
I agree. Yeah, because one of the ways I also, and I'd say this is more recent, maybe over the last 10 years, one of the ways I've thought about my spending, which has really helped, is if I saw, and I love antiques and I love sort of vintage items. If I saw an item and I thought, okay, that's 2,000 or 3,000 or 5,000 pounds, I always think about it, right? If I was to invest this at X amount, what part of my expense can that cover? My council tax bill, my water and electricity, So I started thinking about it that way, that if I'm to spend 5,000 on this, if I invested that 5,000 at maybe 10%, that's a decent amount of money to earn every year. So that also helps me curb my spending. When I think about how much this money could be returning or compounding on itself versus giving it to a retailer. Yeah. So that helps as well.
So as we mentioned, you actually achieved financial freedom in your 30s. What type of investments played the biggest role in helping you achieve that?
I think I would say 4 major types, maybe even 5. So I own and run businesses at the moment, but they are businesses that don't require my physical presence. So they are sort of front-loaded, all of the hard work is front-loaded and they just run. So I run businesses, and I started those way before I retired from my 9-to-5 job. So businesses did help. Of course, investing in the stock markets, whether that's directly stocks or ETFs, index funds, mutual funds, etc. I also own bonds. So bonds are a heavy part of my portfolio, actually, whether that's investment grade or sub-investment grade, sort of risk adjusted, and a little bit of crypto and real estate as well. Yeah.
Okay. And we're going to talk a bit about crypto. It's interesting because you did crypto a little bit, right? As well. Okay. So businesses, and out of those 4 or 5, which would you say has for you brought in the most income? Has it been the businesses? Has it been the bonds? Has it been ETF stocks?
Yeah, no, I think I would say almost equally stocks, bonds, and real estate.
Really?
Yeah.
Okay, those have been the biggest.
Yeah.
Oh, okay.
In terms of income generating assets, I would say those have been the biggest, but the way I've split my portfolio, which is what I'd say to anyone, of course, is you have to have that diversity. So some assets will work towards your income or your cash flow, and others will work or function as your capital growing assets.
Yeah.
So that's sort of how I've set up my portfolio.
Yeah. You know, sometimes what I struggle with is, so the income stuff makes sense. And I've spoken about that on the podcast in terms of like, you know, looking at dividend ETFs and dividend stocks and stuff like that. And I think, you know, that's quite well versed. Like you can Google that and people can find lists and stuff like that. But the capital growth one is interesting. How does somebody figure out, okay, how does somebody get into the mind of frame of being like, okay, I've grown this 100 pot. I'm giving a silly example here. I've grown this 100 pot to 1,000, for example. How do I draw off that? What's like a general rule to know? Let's say the 1,000, sorry. Let's say the 1,000's enough. It covers the expenses. They got £10 expenses a month, roughly. How does someone know, okay, I can start chipping off this capital growth? Because that's very different to like when you're getting income,
of course.
you know, every month. Yeah.
So when you are sat with a financial advisor, one of the things they'd like to understand is what is your objective when it comes to your portfolio. So for some people, it's income generation. I'm not really fussed about whether or not my capital grows as long as it's protected, but I want income from it. For others, it is capital growth. I don't really care about income. Maybe I'm still working or I've inherited some work. I don't really care about income. I just want my capital to grow every year. And for some people, it's a mix of that. So I think, and that is also to some extent based on your risk tolerance as well. You know, how much risk do you want to take in the markets, etc., and with your investments. So if you are looking to, perhaps you've covered the income side of your investment portfolios and you're looking for capital growth, there are certain stocks or certain assets that can lend themselves towards that. So, for example, bonds are on the safer side of the investment spectrum generally. You do have, of course, your junk bonds or your high-risk bonds, but generally, and also you do have your investment-grade bonds, which are the safest bonds you can get. So bonds are not the sort of assets you buy to increase your wealth per se, because they're more income-generating assets. It's not to say that they can't rise and fall. You do have perpetual bonds that just sort of go on ad infinitum until perhaps the issuer calls them back. But stocks, for example, growth stocks are one of the sectors or sort of the parts of investing to watch. So a lot of tech stocks, for example, Nvidia, this is not advice, by the way, it's not financial advice. I don't like to mention specific companies, but I'm giving an example. Nvidia, for example, I don't believe pays dividends. So that would be classed as a growth stock because they plow a lot of their sort of revenues back into growing the business and becoming, they've just hit, I think, $5 trillion in terms of, first in history in terms of market valuation. But there are some stocks that are sort of growth stocks and others that are, value stocks, so value stocks are stocks that are more mature. They are income generating stocks. They pay out dividends, whereas growth stocks tend to be more tech heavy stocks, stocks that they're just looking to sort of keep expanding, etc. So some assets in your portfolio. Again, I don't want to speak too much about crypto, but, crypto is not, although now you do have some cryptos that are income generating when you sort of lock them up or stake them. But initially, back in the day, there was nothing like that. It was just crypto was seen as an asset to skyrocket in terms of valuation. So it really, it's a mix really, but it really depends on what you're after in your portfolio.
Can I get you to explain something for us? Obviously, we jargon-free podcast. I know, to be fair, you as an educator as well, you're like this. So when you say investment grade bond, just to be clear, what's that? What's the investment grade bond? Okay,
so...
And versus junk bond,
Okay, great. No, that's a good question. So in the bond spectrum, you have what's called investment grade bonds. These are the highest rated bonds. So they have low credit risks. Sorry if I'm blocking the camera. Low credit risks. So things like government bonds, A-rated bonds, triple A-rated bonds, I think all the way to double B, I believe. Don't quote me, but I think so. So these are the safest kind of bonds you have where the issuers maybe have think about your really, really blue chip, large companies that have a lot of cash, back in, and they've been around for a very long time. Just low credit risk rather, and higher credit rating. So, government bonds, etc. And then you have, so the US government, for example, is seen as one of the safest, assets to invest in, the US government bonds, UK government bonds, etc. And then on the flip side of that, at the lower end of the spectrum, you have what you call sub-investment grade or junk bonds. I don't like the term junk, but that's what it is. It's
such a weird term, right?
it is, or speculative grade is it's called as well. And these are the higher risk bonds that, they will, because they are higher risk, they would have to, of course, entice investors. So they tend to list their bonds at higher coupon rates. So higher risk, higher credit risk, and lower credit rating, but higher returns. So that's sort of the spectrum across bonds. So when we talk about bonds, are we talking about sub-investment grades or investment grade bonds, etc.? So I hope that sort of clarifies.
Yeah. Thank you for explaining that. Yeah, because we haven't talked about the different grades to bond. I was learning about this recently, about the credit ratings, and it's the way I would like people to kind of think about it is like, we have credit ratings is a similar type of concept.
Exactly.
So that's how I liken it to.
It's exactly
You've
that.
got credit ratings, business have credit ratings too.
Correct.
Yeah,
That's
so
it.
that's how I like it.
Yeah,
it's just a very simple example.
Yeah.
You can use it. I won't charge you for that. Thank you for explaining that, and also thank you for like sharing, in terms of like how your portfolios kind of made up. The real estate one was quite interesting because many people do seem to be in real estate, and the bond was, I was actually quite surprised about bonds, but it does make sense, especially like the income portion of it as well.
Yeah. And the reason my bonds are sort of on par is because, of course, there's a chunk. I've been investing for a while. So when I speak about my investments, I try to be very careful so people don't think I started 2 years ago.
Yeah.
But I'm very risk seeking with my investments. I always have been. Maybe as I'm growing old, I need to sort of taper that a little. But when I talk about the bonds, it's a combination of high risk bonds as well as, to a small degree, investment grade bonds. So bonds that yield maybe double digits or close to double digits, but they're very risky.
Okay. So, wow.
Yeah, that's why I'm able to sort of, there's a mix of things in there.
Okay. Well, we're going to talk about aggressive, literally one question away. I wanted to talk about that period. So roughly how much did you start with, and over what period were you consistently investing before you could step away? Because obviously you just mentioned that, you didn't just start yesterday. So it's
very difficult. It's been a while. It's very difficult to give you an exact number, but I think I would say maybe around 10 to 20,000. It wasn't, I didn't start with 100K because I didn't have it at that point, but maybe around sort of £20,000. I definitely started. So I bought a property. I don't like to class that as the start of my investment. It's my residential property, but I bought a property at that point. But in terms of stock market investing, I'd say, maybe around 20,000.
Okay.
And I've been doing it for, I'd say close to 2 decades actually. So around 18
years.
Yeah, 18, 19 years.
Were you doing 20K every year? Or did you start with 20K
I
as a lump sum?
I started with 20K.
Okay, and then you incrementally.
Correct,
okay.
Yes. As time goes on and you earn a little bit more, you increase.
So 18 years is a long time. How did you...
It's a while.
Conviction to stay like for 18 years. What made you stay for 18 years?
It was the addiction.
The addiction to the money going up.
Yeah, so it was I think as I said to you, I had a plan to retire by the age of 50. I've always known that I was someone who wanted autonomy earlier than 65 or 70 because when people ask me, why did you retire from your 9-to-5 job this early? I say, well, you can always, and I don't mean to sound arrogant, but you can always find work. And I've worked on my CV to an extent where even a job in McDonald's I'll take, but I'm joking. But on a more serious note, you can always find work. But I felt like I want to spend my youth. I want to buy back some of my youth to just enjoy it, doing the things that I'd like to do when I'm 70, but hips hurting, knee replacement, all of those things won't allow me to. So I say to them that I can always find work, but my youth, not so much. I can't get that back once it's done. So, that's sort of why I embarked upon that. But going back to your question on staying the course, I could see the results. Don't get me wrong, some of my positions were very sort of, volatile, but just seeing how you're building wealth for your future. It was, for me, it was all about when I'm 50 and I look back, am I going to be comfortable to say, okay, I think I can survive on this, versus I spend all my money now. So it's about either compounding and growing your wealth for your future self, or consuming all of that now and having nothing, at that age. So that's really what kept me going. I just loved seeing how my portfolio was growing and, investing in very interesting asset classes as well.
Yeah. I've got an interesting question for you, right? Now that you've done the 18 years, what did it feel as long as it's now been? Because a lot of people, when we're saying to them, guys, invest for 20 years, they're probably thinking, I can't wait. Now that you've been through this, did it feel that long for you?
I tell you, time goes by when you're having fun. It really does. Well, don't forget I was working for a lot of that time. So it just, I look back and I'm thinking, gosh, has it been that long already, But I think the time just flies by, because for me, especially because I was working, I was doing other things, I was traveling, I was, taking professional exams and all of that. So it doesn't feel that long. I still feel like I'm in my 20s, but I think when you're kept busy, the time just goes by. It just flies by. So I know a lot of people want, abundant wealth in 2 years and 5 years. It's possible, perhaps if you won the lottery or you came into wealth somehow, but I always like to think about investing on a long-term basis, because for a lot of people that would be the case. It has to be on a long-term basis. So just, keep going.
Yeah. Why is that important that people should try to be a bit more long-term and think long-term? And actually, I guess the question I'm asking you is because although you were investing, your life wasn't being hindered in a way, right? You were still able to do things, but your money was growing on the side.
Yeah. So it a lot of things will be dependent on your income level. I have to stress that. You can get to millionaire status on low income, but it will take a long time and it will take a lot of, dedication and commitment. But we talk about long-term investments because you have to give your portfolio the room to grow and compound on itself. If this thing was so easy and if it was, an exponential thing within a short space of time, you will have more millionaires than you have today. I think the last record shows that we have 1.6 million 1.6% of the global population are millionaires. And just 10 years before that, it was 0.7%. So it's not like you have 10% of the population, So the point being that it does take time. So when you look at the S&P 500, for example, if you look at a small segment of it, so let's say over the last 5 years, you'll see a lot of volatility. So some people, unfortunately, have bought at the highs and sold at the lows, which is not what you want. But if you extend that over a 100-year period, you start to see that upward swing. So you need to give your investments time to grow, because especially in the stock markets, you're investing in underlying companies. And so operations need to sort of extend, expand and grow over time. And so does your investment portfolio. So it's important you think about it on a long-term basis. So you don't make the mistake of losing money because you're chasing the bottom and, chasing, trying to trade alongside volatility. No one can predict the future. So,
Yeah. And this is the thing, I think, the whole, trying to get rich quick and stuff like that. I think if you're in that mindset, it's likely you're probably going to blow it quick too. Rush in, rush out.
Exactly.
Right. If you're a bit slower, it's more considered. I believe you appreciate it more.
Yes.
That's just, my belief. And I think it's more of a balance. So as we mentioned, you said you're a very aggressive investor. What did that look like in practice, and how did you manage risk along the way?
So as I mentioned, every time I got paid, every time I got a bonus, every time I got an inflow of cash, that went straight into either savings or investments. And so I was very consistent with ensuring that, I was investing every single month, every year. I had my targets to hit every year. It didn't always happen. Sometimes I didn't hit my targets. Other years I exceeded it, which was fantastic. So I just kept being consistent. I kept going. But also in terms of my positions, I would maybe put on currency hedges as well. So if I was, because I'm a GBP or a pound-based investor. So when you invest in US assets, there is a currency conversion that happens. And so if I had a heavy position in a US asset, for example, I might use currencies to hedge back depending on where I thought the pound was going to be, so things like that. I was also watching my positions by keeping an eye out for research on the companies, or, if you're invested in ETFs, just understand what's going on with the managers and things like that. So that's really how I managed risk from that perspective. So I had a mix, as I said, in my portfolio. Even though I was aggressive in terms of the percentage I was investing, I also had to make sure I had a diversified portfolio. So I didn't plow 100% into stocks or 100% into bonds. It was, I had a selection of things in my portfolio. So yeah. That helps.
Okay, that's good. So you were diverse. But I mean, you're quite educated in this area, so I feel like you had a bit of advantage.
A little bit. No, it did help, of course, that I worked in banking. That you get a lot of information. You're never allowed to inside trade, so that's a no.
Yeah.
But just seeing the markets every day. You wake up at 6 a.m. You read what's happened the day before everyone gets into work. It's just you get that practice of understanding the markets, and when you trade for clients, when you speak to clients, when you manage portfolios, you have to be forward thinking as well, when you manage wealth for wealthy individuals. So that really helps. It really helps.
I think diversification is very important, and just having this understanding of investing, even at a basic level, is good. Even if you're just going to do ETFs, just really have an understanding. But I think having appreciation for what's going on in the world is important. We're going to talk about why that's important, because at the end of the day, all of these things are connected, right? And it's your livelihood. Not to say that you have to be an investing guru like Warren Buffett or anything like that, or Ray Dalio. You don't have to be that. But I think showing an interest and appreciation for the arena, I think, is important.
I agree.
So you also mentioned to me that your faith shapes how you think about money investing. In what ways do you think it gives you a different perspective on, risk and wealth again?
Yeah, so I was raised in a Christian household, and I tried to live my life according to, backed by biblical scripture. And there's one particular verse in the Bible that I absolutely love, and it talks about diversification. It's Ecclesiastes, I believe it's 11 verse 2, that talks about, it says, invest in 7 ventures, yes, 8 ventures, because you never know when calamity will hit, and you never know which one of those will stick. There's another verse that talks about diligence leading to abundance and hastiness leading to poverty. So, but the Bible also talks about not being greedy and not putting your faith in earthly possessions. So I try to I think those 2 instructions, or those 2 parts of instructions, have their place. So, when positions are going high, thinking, just, one more day, or just nip it. Sometimes you have to
sell when you need to sell.
Sell when you need to sell. Don't get too greedy. But on the other hand, it encourages you to explore and, just have options, because you never know which one of those will be your protector when the time comes. So I've always tried to mirror that when I invest, and it's just generally how I live my life as well. So yeah,
really, really appreciate that. And I think those are great scriptures for people to follow by, and principles, because, as you mentioned, right, in investing, I think the other side of things that we don't talk enough about is the selling part. We get to a certain part, we hit our goal, but it's like you say, that greed is there. Let's get another 10%, let's get another 100. Guys, look, we hit it. Why are we not selling?
I think especially if you are a short-term trader, maybe a day trader, it's the temptation is there to keep going, and not sort of exiting positions when you've put a stop limits perhaps on your position. So for me, I'm a long-term investor, but there have been times when I took advantage of corrections or dislocations in the markets, but I don't do that often. But when there's an opportunity, I might take it. So it's good to have that principle from the start and just stick to it if you can.
And the multiple streams of income, I think, is good, and your journey it shows that, right? You got 5, 6 streams of income, but you were building those over time, which is, another thing that I think people need to consider, that just a little bit of patience with people. Enjoy life, but be patient. We don't need to have everything now. Now, if you are one of those people that really, really wants, I don't know, I was in Miami like a few weeks. I literally got back last week. You're one of those people that you want to live in Miami, you want a nice penthouse. You know what? I don't need to tell you what you need to do that. I think you should be well aware what you need to do if you want to be one of those kind of people, right? That does that, or if you want to be a person that it takes a bit more time, you're gonna have more of balance in your life, because when you mentioned before, you're saying that you're working a lot, right, and it was taken away from other things, and that's what it is. There's going to be a trade-off, and I think you have to understand what those trade-offs are, for sure.
Absolutely.
So on that note, what would you say is the best way for someone to build an investment portfolio that can realistically replace their salary?
So that's a great question. And I'll say that there isn't a one size fits all when it comes to this. There are lots of personal finance advisors or, content online, and they say, oh, this is the way to do it. It might work for some people. It mightn't work for others. The one thing I will say, however, is that your income or your salary is, for most people, not everyone, for most people, that will be the seed capital that funds your investments. So please be nice to your employers and be polite. But no, seriously though, your income is going to be the base that forms all of this. So it's very important to respect that. When people say they want to retire at 22 or 25, it's a bit difficult for me to to speak on that. But I think that it's important to at least see that as the base. Your income is going to be what helps you in the future. But like I said, there are different ways to do this because it really depends on several things. Things like your risk profile, as I said before, your time horizon. Do you have 20, 30 years? Do you have 10 years perhaps? What sort of assets you'd like to be invested in. But I think the overarching principle or the framework within which to get there stays the same. You have to ensure that you're keeping your expenses low, make sure that you are saving and investing. So before you do anything else, it's always prudent to have your life happens fund or emergency fund, as I like to call it, your life happens fund. Some people say you need 3 to 6 months of savings. It all depends, do what works best for you. But you should have that in place before you start any of this, because the last thing you want to do is having to draw down on your portfolio because an event and unforeseen circumstances happened, and you unfortunately have to draw down when we have a recession and things are low. So you don't want to do that. But I would say that if you're starting out, start small, especially if you're doing this by yourself and you're not seeking professional advice. It's really important that you just start small, test things out, see how you feel, what works for you, what sort of assets excite you, and keep with the consistency as well. So I would also say it's prudent to have diversification if you can. I started small. I started with one thing and then it grew into other things. So I know that some investments have minimum investment amounts, which means that you can't dip in if you don't have maybe 1,000 or 10,000, but you don't have to start at that level. Start small. If you're starting with equities, for example, and you are not well versed or you are not an expert on stock picking, you can go for index funds, mutual funds, or ETFs. So instead of looking for that tiny jewel on the crown, so to speak, you can just buy the entire crown, just buy the entire market. So you have exposure to everything in the market. So just be prudent as to how you go about it, but you have to start small and build from there. Yeah. It's a learning curve, so you will make mistakes initially. It's almost inevitable, but don't let that stop you. Just keep going. Yeah.
I agree. I think even myself, investing in, if I look back, I think definitely the ETF index route is 100% probably, if you were to invest in stock market, is probably the better way to get to know the stock market, because it's, the value of your investment. Of course, it could still go down. It likely will, but it's not going to, hopefully it doesn't hit too hard. It's not going down 20% in a day, 30% in a day. So you're a little bit more acclimatized. And then if you want to go into stock picking, then you can then start to understand it a bit more, deep dive. It's like you're it's like almost you're educating yourself, but it's like you're going through a degree, right?
Correct.
You don't start a degree and then they're teaching you third year topics. They teach you first year topics to get into the basics. Then it's second year, then it's third year. And I think people need to kind of do that in that way as well, because investing is such a these days, and we were talking about it offline as well. Like the access to it is amazing.
Yes.
Like the fact that you can now do this on your phone.
Yes.
£1, that's all you need to start. You invest, because I remember when I was gonna start again, because I had invested before, and so I was doing it. I started with index funds too. Dipped out because I bought my property. Then I was getting back into the market, and I was looking to because I was one of those people, right? Like you, I was like, okay, how can I be a bit more aggressive? So I was I can't remember what the word was. Asymmetrical. Somebody said, "Oh, you need to look at asymmetrical bets."
Yeah.
So I was looking at a certain sector.
Okay.
I was like, okay, so how do I buy these stocks? And then one of the platforms was like, I wasn't even going to put a lot of money in. I was just like, I just want to buy 100 and just see how.
Yeah.
They're going to charge me £15 or something. Like, what's the point of that? I'm not going to do that. It's expensive. Now you can do it for one. Now you don't even. Now the fees are a lot less than £15, and that's just been in the last few years. So we do have a very, big wealth building opportunity with us today. So if you had to name 6 types of investments that can replace someone's salary, what would they be in your opinion?
Okay. So if you've been investing, or if you have longevity in terms of allocating time to your investments, so I keep saying this, it's not going to be an overnight event. I would say that real estate is definitely a good one. Of course, stock markets, whether you go directly stock picking or whether you do it through an ETF, but that takes time. That's a good one. Bonds could potentially be a good one. So this is a combination of these things. Unless you have quite a lot of capital to invest, it most likely will be a combination of these things, also to manage your risk, as I keep talking about. So bonds are a good one. Starting a business is always helpful. You can go into maybe commodities trading, but I don't know how much income you'll make from that. But commodities are a good one, and maybe a little bit of crypto as well. The safer coins or the biggest coins. So some sort of combination of that would help if you don't have, $1 million or 5 million or 10 million to invest. So those are not bad assets to look into.
I have a question for you. In terms of like ETFs, because I know we don't want to talk about stocks, as I also try and shy my way about it, unless I'm talking from a perspective of understanding what they're doing or understanding what the company is doing. ETFs, right? Dividend ETFs. Are there any that you've heard of that are a bit more well known that,
There are a few. So I think that the more famous ones, if I can put it that way, are the ones that, so I won't give any specific tickers. Tickers are the symbols that you can use in buying them. But the ones that follow the broader, bigger markets like the US, you have a few that follow the US markets, that follow European markets, maybe Asian markets. So, there are a few I've heard about that are quite decent in terms of their coverage. But with all of these funds, ETFs, index funds, and mutual funds, you can have sector specific. So you don't have to, if you don't want to buy the entire market. So let's say you were interested in the energy sector or utilities or tech or even AI, you can actually buy funds that cover those specific sectors. You don't have to buy the entire market. So it really depends. But there are some, there's some decent ones. Just Google it. I'm sure you, a few of them will come up. Yeah.
And for someone who wants to earn about £1,000 a month in passive income, roughly how much would they need invested to reach that goal?
I get that question a lot.
Yeah, I'm sure you do.
It's a good one. It is a good one. So this question, it's a little bit, it's a broad question and it requires a broad answer. And I'll tell you why. So to get £1,000 a month, let's say we start with equities, for example, just focus on equities. Taking the UK markets, the FTSE 100, which is the flagship stock market in the UK, the yield right now is dividend yield, not the total returns, but the dividend yields are around 3 to 4%. So let's take the higher range of that, which is 4%. So on a realistic basis, making 4% annually in terms of dividends. If you wanted £1,000 a month, that would set you back £300,000. capital, at least initial capital.
Yeah.
And then you can grow it from there. So that's the sort of level you'd be looking at if you invested in, let's say, the FTSE 100. In the bond markets, as we talked about, there are investment grade bonds, like I said. Those will return you lower because they are safer. So you might be able to clip between maybe historically 1% if you're lucky, but nowadays maybe 3-4%, given where interest rates are, maybe even slightly lower. And then on the flip side of that, you have bonds that pay, like I said, sometimes into double digits. So let's say you're earning 10% on a bond, you only need £120,000. So it really varies. Let's come to real estate. On the real estate side, with 60 to 100,000, you can be clipping easily 1,250 or more every month. Because in the UK, I believe the cap rate, which is like your return on investment, is around 4 to 8%. That's the average range. So to answer your question, I would pose another question. How long is a piece of string? It really depends on who you have in front of you. What their portfolio mix is, which itself will be informed by your risk tolerance and your ability to take risks. So it varies at all.
Okay. No, thank you for giving us the different examples and across the range. No, because I think it's important that you answered it that way, because I think it gets people to think in that way and not think one way. And it goes back to diversity. Okay, maybe some of your investments are yielding 3-4%. Maybe others are higher, 5-6%. Maybe, and then across it's giving you, I don't know, 7% or whatever it is. But I'm glad that you mentioned that, because I think people need to have an appreciation for all of these aspects of it, which is the reason why on the podcast I talk about all of these things, so that you can figure out. I mean, if you just want to just do the stock market, you're like, look, I'm not bothered about the rest. I don't want to do property. I don't want to do... I don't want to start a business. Fine. That's up to you, But at the same time, I think it's important that, people are aware that you can think about it and do it in that way too. I appreciate that. Thank you. So when we spoke, you mentioned the term patient capital, which I think is a brilliant term. What is it, and why is it so important?
So in the finance world, I think when people mention that they refer to patient capital, that's usually used when it comes to investing in maybe private ventures or private sort of not listed stocks or bonds or things like that. So private businesses. So patient capital really refers to not your widow's mite, not what you need as an emergency. This is money that you can allow to grow and compound on itself for maybe decades, for example. So not money that you need imminently. So you need to allow, it has to be money that you can put away for 10, 20 years or more and not have to access it. That's what patient capital refers to. It's sort of, if you think about, if you're investing in a startup, for example, you won't necessarily expect returns until it's past that J-curve phenomenon where the company has to sort of grow. And so you're waiting maybe 5, 10 or more years. So it's really a term that's used in private equity investments to say, okay, you have to be patient and, allow, and venture capital investments as well, allow your capital grow. So that's what patient capital refers to. Okay.
But it's something we should bring into the retail world. No, because if people thought about it like that, then I think that, again, then they would think about their wealth building horizon. On a bit of a longer term, and then they're giving themselves more time to build wealth.
I mean, it to be honest, the same principle applies to retail investors. Majority of those who are looking to build wealth will be building wealth over the long term. That long term tends to stick when we talk about personal finance, because if you are able to achieve your goals in a shorter period, fantastic, that's great. But in reality, and I think for most people, this will be long-term anyway. So patient capital, there's sort of transfer as well to the retail sector.
So over 70% of people who watch these episodes are subscribed. If that's you, hit the subscribe button. It really supports the channel, it helps it grow, and most importantly, lets us keep bringing you valuable conversations like this one. Plus, you'll be the first one to know when new episodes drop. Thank you so much for your support so far, and enjoy the rest of the show. In your experience, what are the biggest mistakes people make when trying to chase early retirement too quickly?
So I've heard about the FIRE movement. I actually heard about it 3-4 years years ago. I'd never
Really?
heard, I never heard about the FIRE movement, but it's quite interesting. So I think that there are a few things that one would have to think about if you are looking to perhaps retire earlier than the official age. But there are a few mistakes people make is that so when you're starting out, perhaps, or when you've been doing this for a while, you don't really have a diversified portfolio. So that risk hedging is not really there. People also follow trends and what they've seen online, which unfortunately these days is not, it's supported by social media. So you see your favorite influencer or your favorite, podcaster talking about a specific stock or a coin, and without doing your due diligence or even understanding that their financial standing is different from yours, their status is different from yours, how much capital they have is different from yours. So people chase a lot of these meme assets and meme names online, which is very dangerous. There's also overconfidence as well when you plow in, and it ties into the diversifying points, where you tie in all of your capital into one thing because you are so bent on this working out. That is, in most cases, a mistake. And I think a big one is not thinking about the repercussions of taxation. So people invest without thinking about the tax implications of their investments. So what I say to individuals is always try to leverage whatever tax efficient platforms or schemes there are, because I can tell you, when you've made that million outside a tax efficient account, Rachel from accounting is going to be like, thank you. 50 to 60% of that stays with us. So just make sure you are really just capitalizing on what you have in front of you in terms of just ensuring that you can, cut your taxes within legal frameworks. Yeah.
Taxes are important, especially as
one.
I think I'm hoping this episode will come out before the budget. There is talks about tax, who they're going to take it from, pensioners, are they going to take it from us? I mean, the trend is, because I don't just look at this year, I'm looking at the trend. The trend is these guys want to tax more, right? And they're looking at, I'm not going to speak for them because I'm not the government. I don't know what they plan to do. But I do say to people, this is why stocks and shares ISA, utilize it. Don't know. There's no guarantee. There's no guarantee it's going to be here in the future. So utilize it now while you have it. Just in case. I'm not saying sacrifice and make sure that, live your life. But I'm just saying also just keep an eye that this benefit that we've had might not be a benefit in the future. I don't know.
You're
right?
absolutely right. And the limit at the moment for ISAs is 20,000. Even if they don't completely sort of abolish it, who knows? It might come down to, I heard rumors about £4,000 a year.
Yeah, I've been hearing that.
So you think about it, you're being taxed when you earn your income. You're being taxed when you save. You're being taxed when you invest and make some money for yourself. You're being taxed across board. So wherever you can help yourself with taxation, please go ahead and do it, because it's your money. So.
Exactly. And it's honestly, like, these kind of things, and the 20,000 has been 20,000 for time. They look like they're trying to increase it. So this is what I'm saying, guys. Just kind of, when the writing's on the wall, again, it may not change, but when you've got a bit of a warning, and it's like, just keep an eye on that. Anyway, if it happens, we've all been warned. It's not like we haven't been. So I wanted to talk about the future of money and investing, right? So offline, you mentioned that central banks are meant to have autonomy, but in the US, you've warned that the government is increasingly influencing them, which was an interesting point when we were talking about that. If that continues, what does it mean for everyday savers and investors, and how do they navigate that?
So that comment stems from the comments that the president of the United States made around or about the central bank chair, which, in my opinion, wasn't very helpful. So central banks are meant to be independent institutions away from political influence. And they do that because they make monetary policy around controlling inflation and just, economic policies around that. So when you have a government or president that comes out saying certain things in the media, as consumers of policy, we start to think, well, will future policy be independent, or will it be bullied by political influences? So that takes away credibility, which is, one of the key things around central bank policies and the central bank itself. There has to be confidence to a certain degree of expectations when the central bank says, we're thinking about doing this or doing that, or we're thinking about different policies. So if you don't have that independence, it becomes a challenge for the markets going forward. Because on the one hand, you have the fiscal side of things, and on the other hand, you have the monetary side of things. So there has to be that sort of, autonomy to allow them to do what they need to do to get the economy where it needs to be. Yeah.
And if we lack that autonomy, what can you see in the future?
Yeah, there could be many consequences. So if you have a situation where you have the government trying to keep interest rates very low, for example, even when they should be increased, you have what we call entrenched inflation. So you have inflation for a longer period of time, because when interest rates are lower, people are less likely or less encouraged to save. And so the money supply in the economy sort of balloons. So there's more money chasing each item because interest rates are so low. And that's what inflation is about. You bid up the prices of assets. And so when you have that entrenched inflation, that also feeds into markets. So in equity markets, for example, you start to see assets being inflated, not just equity markets, across board. Asset valuations start to go up, property prices start to rise. And as you know, whenever we have that bubble, the asset bubble, at some point it will burst. And who pays for that? It's investors, really. Yeah. So that in itself is a challenge as well. There's several consequences to this, but it really is around inflation when it comes to a policy that, for example, keeps interest rates so low for too long. So you don't want that interference from the government. You need to allow the central banks, manage monetary policy according to economic data and not pressure from governmental agencies and the government itself.
Yeah. I don't know too much about the US's political system, I'd admit, as much as I understand the UK. I understand the UK a lot more. But I guess people could say with Trump, I guess you would say he does push things to the edge where he pushes as much as he can.
Yes.
That's who he is. He'll push the envelope as much as he can.
That's one way to say it, yes.
What you could say about him is he's a disruptor. He is a disruptor in the sense that he's not trying to do the conventional stuff. He's trying to do the unconventional stuff.
Yes.
Yeah, like you say, the markets don't like that. We like stability. We like the status quo. We know what's happening. We don't like things being, messed up.
And an example of this is, I think it was in April or May this year when you had Japan selling a huge amount of US bonds in response to the policies around tariffs. So when you have that uncertainty around what's going to happen in the future, you get investors very sort of angst and jittery, and that's what causes the gyration and volatility in the markets sometimes. So just leaving the central banks to do what they need to do, I think, helps. Yeah.
So you've seen market bubbles before. Do you think what's happening with AI has the same signs? And if it does, how should long-term investors navigate it? Because I'm seeing a lot of commentary around, we're in a market bubble, AI is faking this, AI is faking that. Everybody's calling for a crash. But I don't know, I don't know if anybody's really been accurate, because people were calling about crash before, but they wasn't accurate. And I mean, if you say it long enough, you're going to be, correct at some point. Right. So for people listening to this now, how do they navigate something like this? Let's say, again, we can't know, but, it's not that a crash always happens, right? It's the same as, it's like cycle. Both, it's a cycle. Cycle happens, boom, bust. That's just the nature of life, right? Yeah. So how can people navigate this?
So I will start off by referring to, answering your question around the bubble, the AI bubble that's going on right now. It's really exciting. It's very similar to the .com era. And just to reference that, a lot of my clients, well, not a lot, but a few clients made a heap of wealth during that period. And it's not that long ago. So this season they were in is, of course, a wealth acquiring season for sure, no doubt. For those who bought some of these stocks or companies way before now, they really are enjoying the dividends around that. But and when I say dividends, I mean the returns around that. But in terms of the bubbles, I was reading an article, a research article from The Economist around, I think 2 weeks ago, and it was talking about this particular subject, which is the AI bubble that we seem to be in now. And it referred to what would happen, the consequences of what would happen if we had an AI bubble burst. And research and expectations are that it will wipe away, if we had this bubble burst, it will wipe away $35 trillion of global wealth. 20% of that, or rather 20 trillion of that is allocated to the US because, again, investments are very US heavy at the moment. So when you look at ETFs that say they are globally invested, you'd find that 50 or 70% of that is tied to the US because, of course, these stocks are US centric and US heavy. So 20 trillion of that would be in the US, wiping away 20 trillion of wealth, which is around 70% of US GDP as of 2024. These are huge numbers. And the rest of that, which is 15 trillion, would be a global wealth eradication. So it is many folds bigger than anything we've seen before. Whether or not it's going to happen, when it's going to happen, no one can tell. You're right. The writing is on the wall, but no one has predicted with accuracy or certainty that this is precisely when it will happen. Now, how do you navigate that? Well, I like AI and, investing in that, that space as much as the next person. But this is also why diversification is important and why I say to people that even though you might be in an ETF, you need to look at, or a mutual fund or, an index fund or whatever, you need to know precisely what the geographical breakdown is, the sector breakdown. Just look, it's all there on the fact sheets of these funds. So look into it to see where exactly is my money invested. It says it's a global ETF, but do I have, so in my personal portfolio, I might have a high allocation to the US. And I'm thinking that my ETF is a diversifier, but then I find out it's not. We're investing in the same thing. So you have a double exposure almost to the US or, I'm not picking on the US. I'm just saying that the research was around what would happen globally, but with particular attention to the US. So one way to navigate that is to, again, stay close to the news, make sure you have diversified portfolios, have some dry powder just in case, there is a dislocation in the market or a recession, and you can sort of dip into your investments at a lower level or, if you will average cost your investments. So that's one way to do it as well. And, look into ex-USD investments if that's possible. So don't just focus
What's ex-USD? I know what that is. But for
ex-USD. I mean, investments outside of America or outside of the US dollar.
Okay.
So maybe, GBP, pound investments or euro investments or emerging markets are becoming very interesting as well. So just make sure you have your exposure is a little bit diversified so it mitigates some of that risk. Another thing to realize is that in the past, when we've had recessions, the US dollar and gold are known as safe haven assets. So you have what's called a flight to safety. So a lot of investors, because the US dollar in a time of recession, it tends to be quite strong, you would have investors flowing capital into the US dollar. But with what's happening with decoupling from the US dollar, people are sort of having these bilateral trade agreements with China. Am I allowed to say Russia?
Yeah, I'm not.
China, other countries around the world, and they're trying to essentially deflate the power that USD holds. We've seen that flight to safety phenomenon isn't really playing out as much as one would expect.
Okay.
So I don't know. It just might be time to look outside the US and USD investments, possibly. Yeah.
I mean, that's not to say that you don't still invest in US, but just be mindful. And I'm glad that you mentioned global because I've spoken a lot about global index funds on the podcast. One of the things, and actually I had a recent conversation that came out and that guest did mention that, like, even global index funds, actually, they are very heavily weighted to the US. So actually it's not as diverse. If it's 70%, that's not diversity. 70% of something. If 70% of your wealth is in something, and I'm not trying to scare people, by the way, so please don't take this as because I'm, I like the US, so don't take this as fear. I think it's just being aware of it. That 70% is more than majority. It's what triple, double the majority of what your wealth is in it. So, and a lot of people are very pro global, global, to the death type of thing. Yeah. But then it's not like, and I know it's the reasons why it's 70%. I won't go into that on the episode. But yeah, I think it's mindful to be aware of that. But those figures are staggering. Actually, that's staggering. I hope it doesn't happen.
I hope so too. I hope so too. It's good to be aware that you know, and when you set your minds to think, okay, well, this is a possibility. At least it doesn't come as an absolute shock to you that some of your wealth has been wiped away because it was so concentrated in industries or sectors that are going to be heavily affected. It's just a way of mitigating risk and being pre-warned, so that at least you can sort of create a buffer, a cushion if it does happen. Yeah.
And I think so. I've also had a conversation about gold, and I have a conversation about crypto coming, and I think potentially this is why you're seeing some of these movements to, I've been told, gold and potentially crypto, because it's like, okay, how do we have something that's outside of this? Correct. And talking about that, beyond AI, are there any other global trend sectors or themes that you think are being ignored but could quietly create the next wave of millionaires over the next decade?
That is a good question. So I wouldn't say that they are being ignored. I think that some of them are in their nascent or sort of infant state, and there is a lot of growth to come. So things like wealth tech and biotech, I would say, is very interesting now, especially with the infusion of AI and technology going forward, and with what we saw during the pandemic, where, again, am I allowed to say pandemic? But what we saw during the pandemic, where we just needed a lot of infrastructure around healthcare. With an aging population, the need is there. So I think we'll see a lot in that space. In terms of autonomous mobility as well, and drones, so Tesla and the rest of them are looking to driverless cars, which are increasingly becoming commercial. There's something in that space to look out for as well. Cybersecurity, the UK government is hellbent on having everyone have a digital ID or whatever. So a lot of our information is going to the cloud, is going online. So there has to be infrastructure around protecting that as well. And I think in some economies around the world, maybe emerging economies, you might have agri-tech becoming a big thing as well. And it is becoming a big thing, and rightfully so. So I think these are sort of the pockets I'd say would see a lot more interest going forward alongside AI. Yeah. Are
there any that you like that you're, interesting? I know I'm not trying to get you to, because we know the financial advice. I mean, and I'm not saying it so that people copy it. Again, this is not about copy. It's more like I'm saying, when I say that doesn't mean you're invested, but ones that you're like, oh, this is an interesting insight. I'll say one that I'm looking at. I don't think I've ever said this. This is a strange one. So I've been I always do my research on things, and the way I am, I'm quite a futuristic person, so I like to think in. I don't want to call myself a visionary, because that just sounds like I'm up there. I don't do that. I don't do that. But I do like to think of the future a lot. So I was into nuclear before a lot of people were into it. The next thing that I'm looking at, or I just do a lot of research and just try to understand trends and things that are doing. Solar's out of play, but I don't know why, because we need it. So that's people's problems. But so for me, I'm thinking about how do we solve our problems, human problems, because that's what I've been taught in terms of investing. When you invest, companies solve human problems.
That's interesting. So I think defense, like you said, if you look at what's going on, in fact, it's one I should have mentioned, but it's not new. It's just, I think there will be increased investments into that space, given what's going on around the world, and, not knowing where we stand. It changes from day to day. So I think that a lot of governments around the world are starting to beef up their defense spending. As you mentioned as well, solar, there is more going into climate tech as well, as we see this energy transition into into hydrogen, carbon targets, whatever it's called. So yeah, there is a lot that will go into that as well. So I think these are a few interesting places that people can watch out for. Yeah. I certainly am. I haven't chosen one specific sort of sector that I'm sort of gung ho about at the moment, but I think it's worth keeping an eye on these sectors for sure.
Yeah. So when you look at wealth creation patterns from the past, .com, real estate, crypto, what do you notice about how early the winners got in?
I think there is certainly a thing to be said for first mover advantage, which is what earlier investors or early adopters tend to enjoy. I think that those who've done well. So I mentioned I had a few clients who had made a lot of their wealth from the .com era because they got in earlier. And the same thing can be said for crypto. I started looking at crypto in 2012, as early as that. And I'll say this one story I don't like to talk about crypto because it's such a sort of hit and miss with a lot of people. And, I try to be very careful with what's said, but I was looking into crypto in 2012, and there was a company called MT Gox, I think, GOX, that were trading crypto at that time. And the funny thing is, I had registered.
Oh.
All that was left was to send through my ID and my KYC, know your customer documentation. But for some reason, I just kept holding back. I don't know whether that was, the Lord trying to help me out because he knew how I would respond to what's going on right now. But I didn't send in my documents, and it just sort of fizzled away. So I still kept my eye on crypto over the years and eventually got in. But what happened with that company is that the early investors unfortunately have lost life-changing amounts because the company went bust. And I think there's still an ongoing a legal case right now trying to reclaim some of that. But imagine if you had invested £1,000 or maybe £5,000 in crypto when it was trading at $80 per coin, Bitcoin, specifically Bitcoin. What we'd be looking at right now. That's a life-changing amount. And I know that for me personally, I would have ended up in hospital. So I think that God had saved me from from the consequences of that. But I think early adopters or early investors tend to reap the benefits, and rightfully so, because they take on a lot of the risks while, some of us stay on the sideline watching what's going on before we dip our toes in. So there is something to be said for, it's the same with sort of venture capital or angel investors who fund these beta stage companies, or, companies that haven't come to market yet, or, they just help them grow. Essentially, they're taking on a lot of the risk, and that's why private equity, venture capital tends to be quite lucrative because you've taken the risk. So there's the benefits to being a first mover.
Definitely benefit, so, but don't try and be too gung ho all the time, because there's also the risk of losing money as well.
Oh yes.
So if you were on the path to financial freedom again, what would you do differently?
Oh, Atto. I think that because I was very committed and, it was my life for a very long time, there isn't so much I'd do differently, but there are asset classes that I think I would have allocated more capital to. For example, I would have, especially in my 20s, I would have been a little bit less uptight about life, because I was just so uptight about investing and I just wanted to hit my numbers every year. I think I'll calm down a little bit and just enjoy my 20s, but that was a mistake. And I think also in terms of the journey itself, I would have definitely owned less possessions over the years, because my expenses really ate into my capital initially. So all of that money that went on things that of little value, I would have curbed my spending a lot earlier and followed my mother's instructions a lot earlier than I did. Maybe
Parents know best.
I'll be in a different position right now. But those are the things I would do differently. Just, just stay on top of the news. I'm not saying be an expert, but just know what's going on. if you're a single stock picker, which is, itself, it comes with a lot of risk, just keep an eye on the companies you're invested in. Just know what's going on. Generally, interest rates going higher, lower, what that means for your assets and your investments, inflation, what that means for your assets, investments, policy changes, taxation, all of those things I did pay attention to them, but I would pay attention to them even more if I was doing this all over again. Okay. So, yeah.
Appreciate it. Thank you so much for your time today, Jumoke, and for sharing your story on how you achieve financial freedom and just really like all the tips around getting to become being a better investor and just how to be diversified across the spectrum. Really, really appreciate all the tips and for what you're doing as well in the community. I think it's great. Keep it going. I think it's very valuable information. And it really does help people, at the end of the day, this does really help people think about their own journeys, because as we all know, this is not something that we get taught in, schools. We don't get taught it at all, right? It's something, unfortunately, you kind of have to just figure out yourself. And then, I always say, I wish I had somebody I could have watched or listened to when I started, because my journey would have been so much. When I wanted to move from saving to doing other things, I had to Google and everything. It was like a minefield. There's no videos talking about, nobody was talking about, okay, this is the next step, or you do this, or you can do property investing, you can do stock. No, I had to just figure out everything by myself. So it was quite a challenge. So, what you're doing is so amazing. And please do keep it up. Where can people find you if they want to connect with you?
Thank you so much. So I'm not on social media actually, but you can find me on YouTube at Jumoke Me. So it's JUMOKE space MI. That's my channel.
Amazing. Yeah. Like I said, it was great having this conversation with you. And, I know this is your first podcast, so thank you for blessing us with this. I would call it an exclusive. Thank you for blessing us for exclusive. Yeah,
thank you so much, Anton.
Really appreciate you. Do you have any final words for watchers and listeners?
I do. So I think, like I said before, there are a lot of personal finance gurus and channels out there and all of that. And while we chase financial freedom, we're chasing money, we're chasing, self-actualization. I think it's really important as well to look after ourselves, look after your health, your mental well-being, look after your peace. Because as you're chasing all of this, if you're not here to enjoy it, what on earth is the point? So it's really important to look after yourself. So that's one thing that I myself have taken better look at and into consideration as I've gotten older. But another thing I'd like to say is that there are things in life you will have to do afraid. Investing, unfortunately, is one of those. But don't let it stop you, because therein lies opportunity to really make a life-changing decision for yourself.
Okay.
So, yeah.
Thank you so much, Jumoke. Thank you. Really appreciate you featuring on podcast.
Thank
you for tuning in. If you enjoyed this episode, share your favorite part in the comments, tap the like button, and subscribe to the channel. Your support is really appreciated. We'll keep working hard to bring you more valuable conversations.